Welcome to Bonding Over Bonds. I'm Lauren Spalton, and we're bonding today with Victory Income Investors co-CIO, Jim Jackson. Jim, we've seen quite a move in Treasury rates in October.
Yes, Lauren, we certainly did. On the shorter end of the curve, rates didn't move much at all. However, on the intermediate and longer end of the curve, we saw rates increase quite a bit. We think that most of this move is driven by the market pricing in higher rates for longer. However, the narrative has changed, particularly after the Fed meeting on November 1st.
It sure did, Jim. After Federal Reserve Chairman Powell gave what the market perceived to be dovish comments after the November 1 FOMC meeting, Treasury rates moved sharply lower.
You know, we think this is just further support for our view that predicting interest rates is an unreliable source of fixed income returns.
Right. You know, Jim, one of the most popular questions we get from clients is, why bonds? We are, after all, in our third consecutive year of negative fixed income returns.
Sure. Now, we still think that bonds are a core component of a diverse portfolio for three reasons. First, diversification. We view 2022, when both bonds and stocks were down, as an outlier. Second, income. Yields are at the highest we have seen in at least 10 years. Third, capital preservation. Bonds historically perform better than stocks during market downturns, mitigating drawdown risk.
Yeah. Well, you know, a lot of investors are really hiding out in cash, as we've seen the assets in money market funds increase substantially. But is there a cost to cash?
Yes, Lauren, we think there is a cost to cash. Cash is most subject to reinvestment risk, and by hiding out on the short end, you are potentially missing the opportunity to lock in higher rates for longer.
Right. Also, returns on cash over time have barely kept pace with or even trailed inflation.
Sure.
Thanks for your insight, Jim.
Thank you, Lauren.
And thank you all for bonding with us over bonds.